There he is. 305.
Represent, baby. Spine some calls, no big deal. No big deal.
Robin Hood's about to get kicked to the curb.
Hey everybody, JC Parets here, founder of allstarcharts.com, and I am joined once again by my esteemed colleague, Mr. Sean McLaughlin. What's up, Shawnee?
What is up, my friend? How you doing? How you living?
Living good. These financials got me pretty excited. They got me excited, these financials, as excited as one can get about financials. But you know me, I'm into relative strength, aren't I?
Well, for most of the year, when it came to relative strength, all we were talking about was energies. But as the autumn continues on, we're starting to reveal a lot more relative strength under the hood.
No, you absolutely nailed it. Nice segue. First, before I get into exactly the point that you were making, look at financials relative to the Russell 3000, pushing up against new multi-year highs. To your point, that relative strength. Now, what were you just saying? You were saying how earlier this year, we were really talking about energy relative strength. Let me take you back to a chart. This is from February of this year. In February of this year, you had energy. This is energy relative to technology. Remember, technology represents a big portion of the S&P 500. So there's something there, but specifically technology, with technology at this point around 25% of the entire S&P 500, energy closer to 2. And look at the ratio. This was the March of 2000. This is when the tech bubble burst. Technology stocks got crushed. And that's when the outperformance of energy stocks began into the 2000s. This is when early in my career, I remember energy doing very well. Technology was an afterthought. We were buying industrials. We were buying financials. Think Merrill Lynch. Think Lehman Brothers. Think Bear Stearns. Think big energy conglomerates, big global companies, industrials. Those were the things we were buying back then. And as we know, over the last decade, technology stocks did great. Energy stocks were the worst. And so energy underperformed technology by a long shot, actually getting back below those key levels. So as we were seeing energy on a relative basis getting back above those March 2000 levels, we're like, hey, this could be the start of something serious. At the time, we were calling it a generational trade, huge opportunity. And let's fast forward to today, and energy is making new multi-year highs relative to technology. To your point, that has been a tremendous trade. So great. It's not about victory laps. It's about recognizing similar patterns. And let me show you again. This was before the breakout. This was after the breakout. This was before the breakout in February, back above the March 2000 lows. And here we are. Look at financials relative to technology. Tell me, Sean, that this one doesn't look exactly like that one.
It looks an awful lot like that one. And, we're seeing it shown up in individual stocks. We've got interest rates rising, which can only help banks. I mean, I'm told that helps banks. I mean, whether it does or not, who knows? But the price action seems to be supporting it, which is what we really care about.
That's really it. So I see tremendous opportunity. It looks very familiar. We're going to stick with relative strength that continues to reward us. And then so great, right? It's like, all right, so financials on a relative basis look great. So what, JC? Why are you wasting our time, JC? So what? Well, here's so what? What's the vehicle? We like Bank of America. I think it's a good representation of the broader space. You could pick Berkshire Hathaway. We do that a lot around here. I don't necessarily think there's a right one or a wrong one for this particular trade. We've chosen Bank of America, but I think you got a few options in terms of which ones you could use. And with volatility low, relative to itself over the past year, going out and buying some calls that expire in the spring. Keep it simple, stupid, huh?
Yeah, it feels like the simplest and most logical way to play this. The bet that we're kind of making here is that we think that if the seasonal headwinds or tailwinds help out, as well as the relative strength just continues to build upon itself, Bank of America has a real good shot at going back and making new all-time highs, or at least new multi-decade highs. I'm not sure if those are all-time highs, but the highs from earlier this year, around $50 a share, it has a reasonable shot at running up there. And if it does, we're buying the April 43 calls. We're paying $1 for them. If Bank of America makes a run at 50, I mean, we could easily have a 5-bagger, 6-bagger on our hands here. And that's the play we're making. These calls currently sport a 25 delta. So what that means is for every dollar that shares of Bank of America go up from here, the value of the options should increase by approximately 25 cents. Now, that delta will change over time, but if Bank of America would have a big run, let's say in the next month, we could expect that delta to remain true, and we get a lot of leverage in that trade, and it'll be a nice win for us.
Love it when you talk seasonality to me, Sean.
I learned it from you, man.
I love it when you talk seasonals, talking about seasonal tailwinds. I love it, Shawnee, baby. I like it. So anyway, he's absolutely right. Seasonal tailwinds. We're just entering the best 3-month period of the year. When you look at a 4-year presidential cycle, again, best time of the entire cycle. So this is the sweet spot within the sweet spot. I think there's opportunities. Volatility is down, which is not something people say a lot these days. But we'll take what we can get and we can go out and get it. So, okay, let's talk risk management. Let's talk profit targets. So we're going to go ahead and we bought the April 43 calls in Bank of America for $1 a contract. What we want to do is when we can sell it, have a resting order, and we can sell half of those calls for twice what we got. We're going to go ahead and take that off the table, and we're going to let the rest run. That's just standard practice, standard operating procedure around here, best practices. So I want to focus more on the risk management side. Taking profits, making money is fun. It's easy. No questions there. Let's talk about in the off chance that we might get this one wrong, Shawnee. What are we going to do about it?
Well, look, there's always a chance that we're wrong, and we size our positions in such a way that when we are wrong, the loss is totally within the specific parameters that we're comfortable with. And so that being said, where I'm considering myself wrong in this trade, wrong or early, which to us is the same thing, right? If we're wrong or early, it doesn't matter.
Especially
we're getting out.
Options.
Right. So 34.50 is the level I'm looking at Bank of America. That roughly corresponds with the pullback that we saw in mid-October. And as the days go by, that will also correspond roughly with the 50-day moving average. So 34.50 is the level. If we can't hold that, then I'm taking the bet off. It's not going to work. We'll sell for whatever we can get for it.
And then at the end of the day, this is, what Sean is describing is an added layer of risk management, because this type of trade already has built-in risk management, because by definition, you can't lose any more than you put in. You're a limited partner in this situation. Whatever you put in, that's the most you could lose no matter what. So there's already an inherent risk management already built into the trade. So what Sean is describing is an added layer to protect yourself even more, so that you won't even lose your entire premium, and you can maybe lose half of that or 3/4 of that, at least salvage something. But again, this is just an added layer of protection, because the protection is already there, which is, I love that about this trade. Right.
Look, if Bank of America is below 34.50, then as far as we're concerned, the trade is not working, and there's no sense in sticking around and hoping and praying for it to come back. We're not in the hope and pray business. Only price pays, as we always say, and price is telling us we're wrong. So time to get out and salvage what we can. That's it.
All right. So let's go over this trade once again. We're talking about Bank of America here, BAC. We're buying the April 43 calls. We paid $1 for them. You could probably get that right around there still. If we could sell that for $2, we're going to take half off the table and let the rest run. And if at any point Bank of America closes below 34.5, all bets are off. Position size responsibly, knowing that there's already that risk management built in. And of course, take profits is what we're going to do. We could take half off the table so that so we have a free ride essentially into the spring. That's the goal here, right, Shawnee?
That's always, well, not always, but that's often the goal with long call trades. We like to take our risk off and then let the rest ride and go for those big winners. The occasional big winners in many cases are the trades that will make your year. And not saying this is going to be the trade that makes our year, but got to put ourselves in a position to get lucky once in a while, right?
And for those of you guys who have been following along with financials potentially breaking out on a relative basis to a big segment of the market, Reminds me an awful lot of what energy did earlier this year in a rising rate environment. What are the best two sectors historically? Energy and financials. So energy has done its thing, obviously, and now financials are setting up in the exact same way. And Sean even bringing in the seasonals there. So, and then of course, you know, if we're wrong, we're going to know early. Well-defined risk, unlimited upside, all the check. I'd put this trade on 10 times out of 10.
All right, take care, everybody. We'll talk to you next time.